In today's video, we're going to talk about a common investing strategy and show whether it's a superior strategy or a complete dud. The strategy in question today is one that is often referred to as buy the dip. As a regular investor, you are consistently going to be faced with a timing question. If you have money to invest, when is the best time to do so? Most commonly, an accumulating investor will have this question regularly as they are making account contributions, but you may also face this question for other reasons, like when you inherit money, receive unexpected windfalls like a bonus, or even if you are moving money from safe investments to more of a growth bucket in retirement. What is the best time to invest? We know that putting money in the stock market in 2008 versus 2009 would have led to wildly different outcomes. And in general, this timing question leads to fears around investing in the stock market at all-time highs. The last thing you want is to feel like a fool who invested in the market right before it dropped 40%, right? If a stock market is at an all-time high, it's more likely to be overvalued, right? Ironically, the opposite is actually true. All-time highs happen, well, all the time. The stock market historically has been at or near an all-time high more often than not. And if you look at the 3-year return of the stock market near an all-time high versus away from an all-time high, the annualized return of investing near an all-time high is nearly a whole percentage point per year better than if you were off the all-time high. So you shouldn't fear all-time highs. Instead, they're actually generally a great signal. But this brings us to the strategy in question, buy the dip. On the screen, I have two hypothetical investments with two timing strategies. The first is the naive approach of simply dollar cost averaging. If you are contributing to your 401k, and let's say you're paid every 2 weeks, there is a 401k contribution that comes right out of that paycheck, and you invest it immediately. And so you can see dollar cost averaging is equally spaced out on this chart. Buy the dip is quite a bit different. Rather than investing on a set, naive schedule, there is a timing element. You choose a drawdown target, let's say in this case 10%. When the market is rising and reaching new all-time highs, you are not in a drawdown, and so you would build up all of your contributions in a cash account. When the market then pulls back and drops 10%, you would make that full contribution from those cash reserves. This way, you are always making sure you're buying at a low point. You are quote unquote buying the dip and expect better returns when you're buying at a discount rather than at or near an all-time high. Now, this approach seems smart on the surface, but does this approach actually lead towards better results? Can it prevent large losses and drawdowns? Well, let's look at the data. We're going to use a scenario of starting with $10,000, and we're going to assume that each month a person is contributing $500 to this investment account. We're going to compare dollar cost averaging, DCA, to buy the dip, BTD. In this first scenario, we're going to start in 1988, and we're going to use a 10% drawdown trigger. Now, if we compare these two approaches, we can see that the buy the dip strategy underperforms by nearly 1% per year, leaving hundreds of thousands of dollars on the table. Moreover, the risk-adjusted return was lower as measured by Sharpe ratio. Now, this is just one simulation of this strategy. Know that timing matters. 1988 through 2000 was a strong period in the stock market that would have certainly biased towards dollar cost averaging. Starting in 2000, however, right before the tech bubble in 2008, should tell a different story. And it does in the fact that buy the dip was closer, but once again we see that buy the dip is an inferior strategy. In fact, as I'll continue to show, during a shorter time frame, we can see that in certain specific environments, buy the dip can be somewhat attractive. But as we zoom out and compare over a longer period of time, the cost of keeping money on the sidelines ends up hurting you far more than it helps you. For instance, here's an example where buy the dip actually does work. If we start the simulation in 2000, right before the tech bubble in 2008, and then we end the simulation in 2010, and we raise the drawdown trigger from 10% to 30%, we see that buy the dip wins in this case. But as you can see, finding the scenarios where buy the dip wins takes hindsight bias. I show a period of investing here where the stock market fell more than 40% twice in a given decade. Because of this, a large drawdown trigger in the buy the dip strategy improves results. But interestingly enough, buy the dip still only barely wins. And if we back out this analysis to a longer period of time and show variations in the drawdown triggers, we can see that the drawdown trigger matters. But on average, it only varies how much you will lose by within the buy the dip approach, rather than moving the data in favor of this strategy. In fact, in this simulation, we see the closest performer is the 5% trigger. And ironically, this is closest here because it's the closest to mimicking the dollar cost average approach. Now, up to this point, I've just showed specific starting periods. Nick Malugi over at Dollars and Data ran an analysis of rolling 20-year periods. He started at zero rather than starting at an initial balance of $10,000 like I did, but he showed that regardless of the starting point or the drawdown trigger, buy the dip rarely outperforms the naive approach of simply investing the money as soon as it's available. Here's another look at the data using a 40-year time frame. Now, what drawdown trigger is used in this analysis? Well, none actually. This analysis is actually assuming the drawdown trigger you would use is perfect timing. So for instance, you would invest back in at the 2008 lows, and exactly at the 2008 lows, you would have perfectly timed the bottom. And here we see the only time buy the dip outperformed was around the 20s and 30s. And that's only because of the Great Depression. And so if you're expecting to see an 80% stock market crash coming and you have perfect timing, I will admit buy the dip does look quite attractive. Outside of that, however, the simple naive approach works better. Now, I want to add a little tangent to this analysis. We've shown dollar cost averaging to be the best when you're contributing to accounts as you work. But what about if you receive a windfall like an inheritance? Is it better to invest all of this money at once, or is it better to dollar cost average into the market over a period of time? Now, many would think after talking about the benefits of dollar cost averaging that this would continue to reign true, that we would see dollar cost averaging outperform. In fact, however, we see the opposite is true. Dollar cost averaging beats buy the dip, but lump sum investing beats dollar cost averaging. So out of all of this, what message can you take away? You can try to complicate the process of timing your investments all you want. You can try to buy the dip. You can try to avoid investing in the market when it's overvalued based on whatever valuation standard you choose. But time and time again, we see that investing the money when it's available is the best approach on average. And this isn't surprising at all. Timing the market is ridiculously hard. So you can get all wrapped up in complex strategies like buy the dip, but in the end, we see that simple wins. If you'd like to learn more about lump sum investing versus dollar cost averaging, click on this video right here and learn why lump sum investing is superior on average. If you like this video, it would mean a ton to us here at Safeguard if you like this video below. Thanks for watching, and always remember, you don't need more money, you need a better plan. We'll see you in the next video.